This program is brought to you by Westpac. Life is eventful. That's why Westpac helps.
This week, 10-year government bond yields in Australia topped 1.8%, more than 75 basis points, or if you like, 0.75% higher than they were just 2 months ago. But investors selling bonds right now must not believe the Reserve Bank when it continues to say that rates will stay close to zero until 2024. So let's bring in here Chief Economist for Westpac's Business Bank, Besa Deda. And Besa, look, this is really in some ways a battle of opinion between the investors on one hand and the Reserve Bank. But for businesses watching all of this, the real world is that their costs are rising. The thing that they can least afford is to have the cost of money, interest rates, rise as well.
That's certainly the case. Look, we've done a recent survey of our small businesses, and small business leaders are saying there's a shortage of labour, there's a shortage of raw materials, and there's obviously price pressures that are existing in Australia but also globally. And part of that is transitory because part of it's got to do with lockdowns, social distancing restrictions. And as we get back to normal, hopefully, and these restrictions ease, some of those pressures will wane. Now, policymakers have been at pains to say it's transitory. And as we know, Ross, when there's an effect that's transitory, policymakers look through it. But interestingly, in recent weeks, some of the Federal Reserve members in the United States have started entertaining the idea that perhaps some of these price measures might be a bit permanent. And the risk is that the longer these price pressures hang around, the greater the risk that they then become embedded in wage behaviours and price-setting behaviours.
OK, so the headline rate of inflation here has a 3 in front of it, but the headline rate of inflation in the United States has a 5 in front of it. But also here, of course, that's partly a wages story. But on top of that also, you've got oil prices going up. You've got fuel prices going up. This is adding more and more to the cost, which, of course, ends up flowing through to consumer goods, to the prices that people pay. And as you point out, even labour costs rise as a result of a lack of workers.
Well, wages growth has been very soggy in Australia for quite a long time, but it is starting to turn a little bit higher. And the unemployment rate at 4.6% in September at a time when New South Wales and Victoria have been in lockdown is incredibly low and a lot more resilient than we anticipated through those lockdowns of the two largest states along the eastern seaboard. So, look, we think the unemployment rate could flirt with a 3 in front of it by the end of next year. So wage pressures could build, and wages are the biggest influence on overall inflation. So that's something to watch. Earlier this week, New Zealand inflation came in a lot higher than what markets anticipated at nearly 5% annual growth. And that's certainly what then spurred some of this lift in swap yields and bond yields in Australia, because markets then thought, hang on, New Zealand inflation was a lot stronger than expected. Perhaps that's going to be the same story next week in Australia.
But isn't the real answer here, yes, there's pricing pressure, which may be transitory. You can look through that. But the answer from a government and maybe a central bank point of view is open the borders, international borders. We saw the first step of that this week with Qantas, rescheduling and re-announcing all of its international flights. But as immigrants can come back to Australia, there's expected to be a very significant increase in labour imported into Australia. And that's the idea, to try and take the pressure off those wages.
Well, certainly that's the feedback that we're hearing from businesses. The fact that you've got interstate border closures is impacting labour mobility. For example, in WA, they rely on fly-in, fly-out workers, so they've got quite a significant skilled shortage in the mining industry. But also we rely on skilled workers from offshore. So having closed international borders has certainly exacerbated the skilled shortage at a time when economic activity is recovering and the unemployment rate is very low at below 5%.
So the Reserve Bank, in trying to work it out and look through this, at what point do economists start to worry? And as you say, some in the United States already are starting to worry about the baked-in inflationary effect, because the worst scenario right now is a rapid increase in interest rates, which leads to, if you like, the big recessionary sort of, if you like, outcome that many people fear is at the end of this very, very successful boom period that Australia has had for asset prices.
Yes, so we don't believe that the RBA will be able to take on a lot of rate hikes in the rate hike cycle when it comes. And the big reason for that is that Australian households are carrying quite significant debt levels, or much higher than what they were historically, particularly around housing. And so what that means is every time they hike rates, it's got a bigger bite, if you like, on the household. So we think that when the rate hike cycle does start from the current level of 0.1%, and we think it'll start in the early part of 2023, we think the RBA will stop at 1.25% for its cash rate.
It's going to be interesting to watch it as well. Besa, Deda, Chief Economist of Westpac's Business Bank, many thanks for your time.
Thank you, Ross.